Integration between financial markets has increased since the onset of liberalisation in the 1980s. However, both theoretical and empirical studies have been unable to definitively answer whether this increased integration is desirable. Proponents of liberalisation point to the benefit of increased opportunities to diversify risk and improve returns, whilst detractors have raised concerns that liberalisation and its associated increase in integration can lead to greater volatility in markets, caused by rapid spreading of market instability across the world. To this end, we ask, is the Australian stock market co-integrated with other markets in the Asia-Pacific region? Hi, my name's Maddie.
Hi, I'm Jamaine.
Hi, I'm George.
I'm Timothy.
And in this study, we examined evidence for co-integrating relationships in the Asia-Pacific region using the frameworks provided by Johansen and Gregory and Hansen. Our presentation is structured as follows. We first provide a brief overview of the existing literature on this topic. We then move to a brief introduction of the models and techniques used to test for co-integration. We then present the results of the tests and provide a discussion on their reasons and implications. We hope you enjoy. A review of past literature has enabled us to draw preliminary conclusions on the interdependence of financial markets in the Asia-Pacific region. Since Engel and Granger laid the foundations for testing for co-integration in 1987, there has been significant research contributions. Important to this study are contributions by Johansen and Gregory and Hansen. Johansen expands on Engel and Granger's model by allowing for more than one co-integrating relationship. Gregory and Hansen develop a method that is robust to structural changes in the data. Similar studies to ours have been conducted on other countries around the world using different econometric techniques. For example, Chowdhury and Marcy analysed the co-integration between Asian markets, and Diria and Chowdhury on European markets. It is widely accepted that co-integration is prevalent among emerging markets, and this is supported by Massey. Narayan and Smith tested for co-integration between Australia, New Zealand, and the G7 countries, but focused on the relationships with New Zealand. Neither the Johansen test nor the Gregory and Hansen test provided evidence for a co-integrating relationship between Australia and New Zealand. Importantly, however, the Gregory and Hansen method was able to find other co-integrating relationships that the Johansen test had not. Aberdeen and Bansheet looked into the co-integration of Asian triangle stock markets, but found no co-integration between the markets. Ibrahim considered the presence of structural breaks in his study, but found no co-integration between the ASEAN plus 3 markets. Samadar and Bunia used the Johansen and Gregory and Hansen tests and find strong evidence that the Australian and Indian markets are co-integrated in the long run, but that a short-run relationship does not exist. Menon, Suber and Sagaran conduct a similar test but find no relationship between Australia and India, but a strong relationship between Australia and Hong Kong. The varying results of existing literature warrant further study into the area of co-integration. We find that while there exists a large amount of literature that discusses the co-integration of stock prices across countries, there is not much literature considering the bivariate relationship between Australia and other countries. Therefore, our study provides a unique analysis of an otherwise widely considered topic.
We use vector autoregressive modelling techniques to study the mutual dependence of stock markets in the Asia-Pacific region. VAR models provide an improvement over univariate AR models because they allow for dependent variables to be estimated using lagged values of itself and other variables. This is highly relevant for stock market price indices, where the deregulation of financial markets across the world in recent decades suggests a more interconnected relationship. We consider the bivariate relationship of Australia's stock market with those of the Asia-Pacific region, with the bivariate VAR model specified here. For a set of variables to be co-integrated, they must be non-stationary in levels, but stationary after differencing. Granger's representation theorem states that a set of co-integrated variables can be expressed as a vector error correction model. Essentially, this is the first difference VAR model. For our study, the most important feature of the VECM is the pi matrix. By analysing the VECM, you may notice that, since YT must be integrated of an order 1 or greater, delta YT will become stationary after differencing. However, this is only true if the pi matrix produces linear combinations of yt minus 1 that are integrated of order 0. What is multiplied by yt minus 1 to produce these linear combinations are referred to as weighted co-integrating relationships. Decomposing the pi matrix shows that testing for the rank of the pi matrix is equivalent to testing for the number of co-integrating relationships. The Johansen test uses VECM representation to test for the rank of the pi matrix. The test follows a multivariate Dickey-Fuller unit root distribution, with critical values dependent on the dimension of the VECM and the specified deterministic trend of the model. The null is rejected when the test statistic is greater than the critical value. When we fail to reject the null at r less than or equal to p, we say that there are p cointegrating relationships. In our study, we consider models with a constant, with a trend, and without either. One weakness of the Johansen test is that it assumes the cointegrating vector is time invariant, and as such, tends to under-reject the null of no cointegration in the presence of structural change. Gregory and Hansen introduced a dummy variable to model structural change and denoted three models: a level model, trend model, and regime shift model, which consider the presence of a level shift and trend, and level shift, time trend, and slope change respectively. Test statistics are the infamous of the augmented Dickey-Fuller and Phillips tests.
For our data, we consider the opening weekly stock price indexes for Australia, New Zealand, China, Japan, Hong Kong, Singapore, Taiwan, and India, converting all of these prices to Australian dollars. Our selection consists of Australia's largest bilateral trade partners in the Asia-Pacific region, aiming to reflect the idea that co-integrated markets are likely to be economically interdependent. To overcome the issue of missing data caused by variances in observed holidays, we inputted new observations using cubic spline interpolation. This method fits a spline to the data by constructing a piecewise third-order polynomial using a current and future observation. Although some inaccuracies may arise due to the use of future observations in this method, given the large dataset and the very small number of missing values, these inaccuracies should be minor. Further, alternative methods, such as simply ignoring the dates with missing data, would likely produce biased estimators, as these dates are non-random. The New Zealand stock prices exhibit a clear time trend that strongly suggests non-stationarity, and also suggests that the New Zealand and Australian indexes are not interdependent. However, there does seem to be a relationship between Australia, Hong Kong, and Singapore. Around 2015, we observe a gradual fall in index prices across all indices, and in March 2020, all series exhibit a sudden negative shock, which coincides with the onset of the COVID-19 pandemic. Interestingly, there seems to be a reasonably high correlation between Australia and all other indices, the highest being with Hong Kong and India. This provides reasonable grounds to use more rigorous methods to test for co-integrating relationships. To run Johansen tests as well as Gregory and Hansen tests, variables must all be non-stationary in levels and be integrated to the same order. We use the ADF test to determine the stationary properties of our data in levels and in differences, as well as with and without a trend, the lag lengths being specified by the Kike information criterion. We see that all variables are integrated of order 1 without a trend at the 5% level, and that all first difference series are integrated of order 0 with and without a trend at the 1% level. The results show that all stock prices except for New Zealand and Japan are non-stationary with a trend. Since the data series exhibit non-stationarity in some form, we continue further tests for cointegration. We use the Johansen test as a benchmark to determine whether structural breaks affect the long-term relationships of the stock price indices. To run Johansen tests, we must specify the lag order of the VAR model. We use the AIC following conventions set by the literature in setting the maximum order of lags equal to 12. Our results indicate that only New Zealand, Japan, and Hong Kong share co-integrating relationship with Australia at the 5% level. Of these markets, there seems to be clear evidence of co-integrating relationship only between Hong Kong and Australia, with the tests reporting varying results under different deterministic trends for New Zealand and Japan. This inconsistency warrants the use of a method more robust to structural breaks in the data. Hence we run Gregory and Hansen tests, having previously determined the stationary properties of the variables. The lag order is again determined by the AIC with a maximum lag order set to 12, the table reporting the resulting test statistics. We find that Australia is co-integrated with Hong Kong, Singapore, Taiwan, and India, with estimated breaks occurring at various times throughout the decade. The result for co-integration between Australia and Hong Kong is consistent with the Johansen test results, with estimated break dates occurring around 2014. However, the test reveals that structural breaks have a significant impact on Australia's long-run relationship with New Zealand and Japan. Further, data from India clearly suggest a relationship with Australia, with test statistics for all model type significance at the 5% level. Results also suggest a relationship with Singapore and Taiwan, but not China and South Korea.
Both the Gregory and Hansen method and the Johansen method give clear evidence of a cointegrating relationship between Australia and Hong Kong. This is consistent with the plot of the indices, which suggests a common trend between the two variables. Hong Kong and Australia share similar levels of openness and strong bilateral trade ties. These factors imply cointegration by underscoring direct economic interdependence. The Gregory and Hansen method estimates a breakpoint at around late 2014, which could be explained by the weakening economic performance of China. China is both Australia's and Hong Kong's largest trade partner. The slowing growth of China that became more rapid in 2015 would have certainly affected growth prospects for industries in Australia and Hong Kong, and thus investor confidence in the markets. As such, investors would have sought to spread their risk throughout the region. At first glance, it is surprising that the Australian and Chinese markets show no evidence of cointegration. However, perhaps the most important argument for the existence of cointegration are China's restrictions of foreign capital flows. The Gregory and Hansen test estimates a breakpoint at around early 2016. This coincides with the slowing of the Chinese economy that has occurred since 2015. This would have reduced investor confidence in China and Australia due to Australia's close economic ties with China, leading to portfolio diversification in alternative markets. Australia and China also entered into a free trade agreement in 2015. Klein finds evidence that such FTAs can adversely affect stock prices by exposing domestic industries to foreign regulations and institutions, and we note the fact that China's political ideologies, regulations, and institutions do greatly differ to Australia's. The relationship between Australia and Singapore and Taiwan is somewhat expected. All markets share similar financial institutions and levels of economic openness. Additionally, Singapore and Taiwan are two of Australia's largest export markets, suggesting strong economic interaction. China is also both countries' largest bilateral trade partner. This invites a similar analysis to that applied to Hong Kong, where China's slowing growth might have encouraged investors to spread risk by diversifying portfolios throughout the region. We find no evidence of a cointegrating relationship between Australia and South Korea. This result is surprising because of strong bilateral ties and Korea's relatively open financial markets. However, foreign equity ownership in Korea has fallen over the recent decade, suggesting a divergence from integration with global financial markets. Political unrest and widespread news coverage of corruption may have contributed to reductions in investor confidence due to fears of a poor institutional framework and uncertainty regarding the effectiveness of company executives. Evidence of a cointegrating relationship between Australia and Japan as suggested by the Johansen test disappears in the Gregory and Hansen method. A structural break is estimated at around early 2012. This break date could be explained by the Japanese tsunamis and earthquakes that occurred in May 2011 and their prolonged impact on economic activity in Japan. Japan's openness exposes it to foreign investor behaviors. As such, capital outflows that may have resulted from fears about slower economic growth could have altered the potential for any long-run relationship between Australia and Japan. The Johansen test and Gregory and Hansen test suggest conflicting results with regard to the cointegrating relationship between Australia and New Zealand. The Gregory and Hansen test result is surprising given the strong bilateral trade and political ties between the two countries. However, an estimated structural breakpoint of 2012 coincides with the aftermath of the Queensland floods and may provide reasoning for this break in the long-run relationship. The floods had a lasting impact on the Australian economy due to the financial cost of repairs and damage to the agricultural industry, which may have impacted investor confidence in the Australian market. The Gregory and Hansen test shows clear evidence of a cointegrating relationship between Australia and India. This result is consistent with other studies that similarly found a long-run relationship between the two countries. Over recent decades, India has embraced international financial integration through the gradual deregulation of financial markets and openness to foreign capital. This suggests a financial market that has a high dependence on foreign investors.
Our results indicate that structural breaks in the stock price indices had a significant negative impact on the long-run relationship between Australia and New Zealand and Japan, and a positive impact on the relationships between Australia and Singapore, Taiwan, and India. We find no evidence of a structural break having any impact on the relationship between Australia and Hong Kong and South Korea. Our results indicate that there exists portfolio diversification benefits for investors investing in the Australian market and in the New Zealand, Chinese, Japanese, and South Korean markets, by implying that the asset prices in these countries diverge over long periods of time. These benefits include lower risk exposure to equities that may move together over the long run, as well as higher profits by investing in markets that have different long-run equilibriums. However, our study only considers the long-run relationships between Australia and Asia-Pacific stock markets. As such, there may exist periods of time in the short run where arbitrage opportunities arise in Hong Kong, Singapore, Taiwan, or India as relationships trend away from their long-run equilibrium. The gradual opening of the Chinese market to foreign investment that has been occurring throughout the recent decade could result in reduced demand for equities in other Asia-Pacific countries as investors seek diversification benefits that cannot be achieved elsewhere. Australian investors could divert capital away from the Hong Kong, Singapore, Taiwan, and India markets and into the Chinese market. Likewise, investors in those markets could divert capital out of Australia and into China. This would strain liquidity in the co-integrated markets. Going forward, further research should be conducted to determine whether the COVID-19 pandemic has altered the long-run relationship between countries. All countries experienced a shock at roughly the same point in time as a result of the implementation of harsh policies such as lockdowns that forced many economies into recessions, which may have affected certain markets more than others. We hope you enjoyed this presentation. Thank you for watching.